Hello and welcome to Money Matters. I'm Sarah Peterson here with Dean Greenberg and Todd Glick Jr. of Greenberg Financial Group. Hello, gentlemen.
Hello, Sarah.
Oh, you've got the energy today. I can feel it.
Oh, yeah.
I'm ready for you. Okay, today we're going to deep dive into psychology. No, okay, we are going to, but I want to talk about the psychology of financial decision making. You guys really are like financial therapists. I mean, I can't think of two things that are closer to somebody's heart than their health and their wealth. And you really need to get to know your clients in order to properly advise them. So it's so much more.
What do you think the number one thing is to be good at that?
Listening.
You have to care. You honestly have to care about the person, not just what they're going to give you, but what you can do for them. And that's kind of the mind frame that we have. What can we do for you to help you? Which makes you a better person, which helps you take away your stress, which helps you retire. I'm a big proponent. I mean, you know, I am one of my clients, you know, and we talk about it and how to deal with their wealth, with their children, how to deal with their wealth on spending it. And we all do such a good job of accumulating that wealth. Some of it takes longer than others, okay? But one of the things I know is that things have come together for me. You know, I'm blessed over the last few years. But everyone says, but then you know how to spend it within the means that you can. You are enjoying the fruits of your labor. Most people do not enjoy the fruits of their labor. They think that they have to keep all this money forever, and they're always afraid they're going to lose it.
That's one of the most favorite things that me and Dylan, we're in the financial plan, what we'll always do with the new client, especially if it comes back as a 99% success rate. It's a very strong plan. Well, then let's stress test it. What's the max end of spending that your plan could survive before it actually does start to go to 85% success rate, right? Start to show some cracks in the plan. And we've had people that live off $36,000 a year realize they could spend $120,000 a year, still have the same 99% success rate. Obviously, the ending value that they're leaving to their estate will be less, but they've used more of what they actually worked hard for, what they've accumulated over their working years. Some people, they're okay with leaving a whole bunch of money to their heirs. But other people, they'll come into us saying they want to bounce their last check. But then we'll show them that at the end of their plan, they still have $3-4 million because they're not spending enough.
What is this,
now.
Brewster's Millions? You remember that movie where how can you spend all that money and have nothing to show for it? And he was having the toughest time doing it because there's always kind of something to show for it at the end. But
I don't know what you're talking about.
Oh, I know, you're so young. You're so young. But it's not a challenge for us. I mean, we know how to spend, right? But it's a saving that is hard for a lot of people, or how to create that balance.
People don't know how to spend.
Yeah.
They spend way too.
Who are these people?
Yeah,
You need me to show them. Is that what you need?
You know how to spend, but I promise you, as much as I know you, and I'm not coming down on you.
Yeah.
You're not spending within this. You're just figuring out, I have money, I can spend it. You probably have never put a plan together and figured out where you are and what's going on. Because you know what? You have a great relationship with your husband and your family.
No, we do work within a budget. And I do, and I actually like that. And I have noticed it's psychologically more, it makes me feel calmer to have those parameters so that I know I can work within them. No, everybody needs some structure in their life, and that just takes away the fear. Then I don't, I'm not saying, okay, did I overspend? Because I know this is what we've already decided is where we're comfortable, so that I don't have to then fix my mistakes.
And you can't spend to the limit every month because you got to put money away. Because guess what? Your air conditioner goes out. Something happens to your car. Yeah. Something health plan. Something happens that you don't expect it. Where it used to be hundreds and then thousands, now it's $5,000 everything something goes wrong. It's unbelievable how much more it costs. So if you're not doing it the right way, but people don't always know how to spend, because spending means you're still able to put some money away. Spending means you know how to go and do your vacations within the limits of what you can afford. Not overspend. And there's people that underspend. Okay? They'll go on it, they'll have plenty of money, but they do it cheap and they go, I hate vacationing. You know what I mean? And I see that all the time.
It's a real easy reason to understand this. If you've been disciplined over 30 years and you've been living on a small budget and you've been putting money away like you're supposed to, you're disciplined, and all of a sudden you've amassed a net worth of $1.5 million in your liquid portfolio. You have everything you need on a monthly basis. You've been using $36,000 a year. That's what your budget is. You're getting that through Social Security. What do? Well, all of a sudden, these assets keep growing and keep growing. They don't realize they can actually use some of those assets to spend more. But they've been so used their entire life of living on $3,000, they can't imagine living on, what would I do with an extra $3,000 a month?
Here's a perfect example. Cruises. The cruises can be there for someone that wants to spend $800 or someone that wants to spend $25,000. Say you have the ability to be able to spend $12,000, but you go and spend that $800 because you want to save all this money. Now where are you? You're at the bottom of the boat, inside with no windows, right? And you leave, and you go on this cruise, and you go, I hated it because I didn't know what time it was. It was down in the below. I felt the waves more. I'm not doing it again. But if you went and spent that $4,000 or $5,000, which is less than you could have spent, and you got a balcony, now you come back and go, man, I love that. I can't wait to do it again. Because you were able to be on a balcony and see that. Now, if all you could afford was $800, you'll come back and say you loved it. Because you got to do something that everybody else was doing it, and you didn't care where you slept. Does that make sense?
And the only way you know what to afford is by doing the plan. I mean, we'll put together a budget of, say, $15,000, $20,000 a year for just that purpose. And so if you're undershooting that budget, then you're undershooting yourself. We want to hold yourself to the standard of saying, you worked all these years to live the retirement that you wanted to live. What does that retirement look like? And then we're going to hold you to that standard of making sure you're living that quality of life. I mean, it drives us crazy when people have amassed all this wealth and then they don't know how to spend it now. And it's going to go to the next generation. And honestly, most of the times the next generation,
gonna blow it.
They didn't work for it, right? So they don't have the incentives, that they don't understand why that money is there in the first place. They don't have the foresight. And that's why also we try to educate the next generation as well to help them not make those mistakes. But yeah, getting a lump sum of money all at once, and that's a big topic that we talk about all the time, is inheritance. If you get a whole bunch of money all at once, you need to come in and do a financial plan, because if you don't, you could be really hurting yourself in the long run.
I think that this is an education we all need, and the fact that we can offer this to your clients or to the viewers for spending the time with us, there's no downside to learning. There's no downside to educating ourselves. If you're on the wrong path, don't you want to know now? It might not be your favorite conversation, but by the end of it, you're going to feel so much calmer making financial decisions because you know that you have a plan in place. So that phone number is 520-544-4909, or you can scan that QR code and stay with us because we're going to come back and talk more about your money matters. We'll see you in a minute.
This is Money Matters with Dean Greenberg of the Greenberg Financial Group. I'm Spike Spangle. Dean, what really got you started in this industry?
It was because I was working for Ford Motor Company. I had ordered all the dealerships, and I kind of looked at things and I said, this is not what I want. So I went back and got my MBA in finance and investments and said, I'm going to work on Wall Street. I didn't really know the journey I was going to have until later on, 1987, when the market crashed.
Yeah. Black Monday.
Black Monday. The only person in a company of 600 and some odd brokers. I was buying IBM, and I opened a $500,000 account. So they say to me, hey, this is unbelievable. How did you do this? What did you do? I just said, because I thought it was the right thing to do. Down 20%, it was probably a good time to buy, and I was more of a technician and an advisor and an educator at that time. Long story short, they tell me a week later I never owned the stock. The back offices back then could not handle 1 billion shares a day. So a week and a half later, they tell me I don't own it, and I needed to call the client to tell them they didn't own the stock. And I told them that they should pay the client. Next day I came in, my box of stuff was in there, and they told me I was fired. And I went to go see the guy I knew to go get a job. And he said, Dean, I'd hire you tomorrow, but you need to start your own business. I laughed at him and said, how am I going to start my own business? I only have $5,000. He said, figure it out. We're all salesmen. You educate. You care about the markets. You care about your clients. So I guess I figured it out.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg and Todd Glick Jr. of Greenberg Financial Group. And we're talking about, there's so much psychology that goes into spending, why we spend and why we don't, and how and why we save. And it's so interesting how much you guys need to understand the reasons why to better advise your clients.
Well, from an investment part, okay, it's very important for us to know how much savings and what people are spending. Because the only reason the stock market goes up is because people spend money. You have a good economy, people spend money. People spend money, corporations make more money, their stock price is valued more. If people go ahead and we have a problem with our economy and people spend less money, they bring it in and save more, then the companies don't have their earnings and their prices go down.
And I also think, investing needs to be a bill in your financial plan, especially when you start young. We hear it all the time that people, maybe they haven't put away the money they need to for retirement, and then they realize they need to put more away, and it's very difficult to cut back expenses. But if you start young and you've always known that, hey, 10% of whatever I make is going to go to investments, whether I like it or not, you start to really get used to that bill, and you don't actually miss that money because you've always lived with that quality and standard of living. And this is a great example because starting early is so important with compound interest. If you had someone that was investing $5,000 a year at the age of 25 and did that for 10 years, and they averaged 7% of return, but they stopped contributing completely after 10 years. But then you have another person that started at age 35, and then they do the same $5,000 a year, but for 30 years. That person, the second person, puts in 3 times the amount as the first person, but the first person is going to actually have more at the end at age 65 than the second person, putting away more money. And the reason being is compound interest. And that's just with a simple 7% annualized return. I mean, that individual that put $5,000 a year away at age 25, did it only for 10 years. After at age 65, it amasses to around $602,000 at a 7% annualized return. You would have got even more if you just put in the S&P 500, which has averaged 10% going back to the 1950s. So when you can set it and forget it and have a disciplined approach to your investing, over the long run, you're going to find success.
It's a great example of time is on your side, so it's never too early to start. And I think what's nice about that is there's a lot of young people who are saddled with a lot of school debt and other things that's really stressful, but if they can find even a small amount, that can impact them over a lifetime. Because I think some people think, oh, I can only put away, maybe it's even just a few $100s a month or something. But even if that's all you do, it could be very impactful in 30, 40 years.
It's so true. Any amount is so important. We don't have account minimums at Greenberg Financial. We'll work with anyone, and it's important just to get started. And yes, you might have some debts, so you're not able to put as much away right now. But then eventually, once those debts are cleared, you take all that money, you put it into the investments, and then it grows for you even more. And having that disciplined approach over a long period of time will work as long as you don't freak out at bottoms. I mean,
here's another problem, okay? Somebody's able to put $1,000 in. Do you agree or disagree that if they earn 20% the next year, that's a lot of money?
That's a lot.
Okay? How much is 20% on 1,000?
$200.
$200.
$200. So they look at $200 as being anything big time on their investment. No, that's the problem. They don't realize they get like, oh, so what? I put $1,000 in. I only made $200. They'll never get to the point that they have $100,000 that they make 20 grand. Or $200,000 that they can make 40 grand, and unless they put the money away. That's the problem. $200, they can't even go buy a pair of shoes in their mind, right? But it's so hard for them to put away $1,000, so hard, easy for them to spend $200. Mm-hmm. It's got to think the other way. It's got to be easy to put away $1,000 and hard for them to spend the $200.
Another thing I think is people are afraid to put money away, especially in retirement accounts, and think, oh, I can't touch this money until I'm 59 and a half. Like, I can't have that. Well, there are actually rules that you can take out of traditional IRAs for one-time exclusions, like a first-time home buy. If you get divorced, there's a lot of one-time, hard-time exclusions that you can look up on the IRS that actually allow you to get out before 59 and a half without the penalty. But one of the things that most people don't know about the Roth IRA is that you can take a principal pull out anytime that, say you put $5,000 in, you can take the $5,000 out. It's just the growth on the money that you can't take out. And personally, I think anyone under the age of 40 should definitely putting all their retirement assets in the Roth bucket. After 15 plus years of compound free growth, which is what you get in the Roth instead of the IRA, which is tax deferred growth, you're going to make up way more in tax savings in that compound free growth than you do on the first year tax deductibility that you get from an IRA contributions or a traditional 401k contribution. So again, retirement plans, 401ks right now, 86% of them in the US have Roth 401k options, but most people don't even know that's a thing. They don't know what the difference is. The traditional 401k, you're getting a deduction off of your income for that year. That money goes into a bucket that grows for you, and then at retirement, when you take the money out, you pay taxes at that income rate at that time. Where at the Roth, you're paying taxes at today's rate, at your today's income bracket. It grows for you. When you take it out, you never pay taxes again.
I am not a fan, absolutely not a fan of putting your money into a retirement plan, thinking it's your piggy bank like a savings account, and using that money to pay off bad debt. People will borrow money from their 401k plan to pay off credit cards. That is the worst thing that you can ever put in there. Now, if you're borrowing money to buy a house, all for it. Borrowing money to buy a car, not for it. Okay? You are taking money that can grow out. Oh, I'm paying myself back with interest. You are taking money away from that. Save the money. You're still putting money in. That's stopping you from putting other money in that you're paying yourself back. Imagine if you were able to not buy whatever you did to take the money out and put that money in to save more. All right? That is where it's all backwards. People take money from their retirement plan, then they turn 65 and go, yeah, if I didn't take out the $200,000, I'd be in better shape. Yeah, that 200 would be probably 800,000 by now over time. But you didn't do it, and I am not a fan for it. Bad debt, good debt. I'm okay with good debt. What's good debt?
Good debt is anything below 4% interest rate for the most case. But also it's a loan on something that's productive. So a student loan is considered productive because that student's going to go back to work. But if you're an art major, maybe not the most productive job to be getting your loans for. So it does depend. Not all debts are good.
Well, I don't care if they're an art major. Just make sure you do something.
You got to find a job that's going to pay.
Don't
for
go,
it.
oh, I'm an art. See, here's the problem. People become art majors and history majors and philosophy majors, right? And they get out and they can't find a job. They go, what's the matter? Oh, I was an art major. Oh, I was a philosophy. Okay, that's the problem. You should be excited about what you are and go find a job. Okay? The problem is they use it as an excuse of then don't take out the money. Don't do those things. You did it because you thought it was cool. You thought it was something that you really wanted, and at the end, you realize, wow, that's not what I wanted.
Yeah, I mean, half the things people buy are because they think it's cool or someone else is doing it,
and
right?
well, and that is so much more the psychology of spending, and that's why there is the term retail therapy, right? It is somehow a stress reliever for some people, and it's like you have to sometimes stop yourself and say, why am I buying this? Why am I spending this? Do I actually really need it? Is this an impulse? Is this, and that's something that that's something that I think happens with maturing and growing up. But I think in terms of looking towards retirement and having a plan, that's different because you're worried, okay, I'm not getting the income anymore, so how do I still maintain just the simple things, the things that I need, and also have money for the things that I might
Do you know what the #1 addiction in the United States is now?
Do tell.
Amazon.
Oh, geez.
Think about how
You're
many
talking to
people
me?
every day have Amazon packages. I don't get it.
I oftentimes think if we had to pay cash for every purchase, we would make a lot less.
Oh, certainly.
Something about just actually having to see the amount of money physically and give it versus just tap
Even
it.
if it was just
Well,
debit
how about the
instead of
fact
credit,
that your phone doesn't hold your credit card and you actually have to take it out of your pocket and put it in every time? No, it's so easy. I want to buy this. Boom, 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 boom. Just pay here. It's ridiculous. Amazon packages should not be at everyone's house or office every single day. And it's usually multiple.
But this is the generation of I want it now, I want it in 2 days, I'm not gonna wait for it. Same thing with like sell it and go. I want to not get out of my car, pull up to a,
and actually get 100 steps in.
Right. So we have to shift the mindset. What do you call it? Old school? Wait, new school?
Yeah.
Yeah. We have to shift the mindset, and this whole show is about mindset and how that impacts the way we look at finances. If you haven't had these types of conversations before, these are the guys to come in and do it with, but this is a way to educate yourself because there are so much information out there, and we're going to streamline it so that you find out whether you're on the right path and you can do those things in your retirement that you have so deserved. That phone number is 520-544-4909. You can scan the QR code. We'll take a quick commercial break and we'll come back and talk more about your money matters. Stay with us.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg and Todd Glick Jr. and we are talking about the psychological side of spending. It is so interesting because there's so much emotion. Also, the topic of retirement is just, I think in general, pretty emotional for a lot of people because it seems like the end of the phase that's the longest of your life, right? This phase of working hard and accumulating, and it feels like the end, and it's like a little scary. It could be exciting for a lot of people, but it's intimidating because the money's not coming in necessarily, but it's going out still. And I think a lot of people don't feel prepared for it. You gave me this statistic that 87% of millionaires feel prepared, but the rest of the population does not. But that seems kind of crazy to me because there are all these tools available to help us feel prepared. We're just not utilizing them.
And I think that's just because millionaires take advantage of the tools.
Correct.
It's not because the everyday retail person can't actually use us. We always say it's a free financial plan. Anyone can use us. We don't have account minimums. Whether you have 100,000, whether you have $1 million, whether you have 10 million, we'll help everyone the same because as a financial advisor, we have a whole bunch of tools in our tool belt. There's not a single one that we care more about or the other. What we care about is you and what your goals and objectives are and your risk. And with those two things, we'll find the best tool to get you to that end goal. But that ultimately is how you actually go through a financial decision, is looking at all your options and finding the pros and cons and then figuring out what's the best decision for your unique situation.
What about the financial impact of those people who think they're ready for retirement, but once they get there, they realize this isn't for me. I'd like to go back and work part-time, and maybe they've started taking Social Security. I think there's a lot of...
That's the problem when Social Security. If you take Social Security before your full retirement age, which right now is about 67, you'll be penalized if you do that, okay? And you don't want that. So be very careful.
Once you start making over around 22,000,
Right.
that's the amount right now, yeah.
The biggest problem is people who go into retirement without a plan of what they're going to do. Yeah, we're talking about the money, but they don't have a plan. Well, I just figure it out. Let me tell you something. You start sleeping in later. If you're not working out, you're not feeling great. You don't have a purpose in life. A lot of people, if you don't have a hobby, if you don't do something, if you don't travel, you have to do something. Waking up every day without a purpose is pretty boring. And unfortunately, I've seen a lot of people not make it through a long time retirement when they get there. And that's the worst. You hear those stories all the time. He just retired less than a year ago. Boom, dead. Oh, 2 years, he's dead. You know what I mean? When you go to retirement, you want to think you're going to live to your 90s or more.
Yeah. So how do you deal with when people come to you and their one spouse maybe is ready to retire and one is not? This is another like financial, psychological, conundrum, emotional.
Because you figure out what they want and what they want to do and stuff like that. I think a lot of them is they come and one person wants to do things and the other doesn't want to. That's more of a problem.
So it's more, how are we going to spend? How are we going to utilize it? Yeah. There's just so much emotion that goes into all of it.
Humans are social butterflies, right? We're social creatures. We need social connection to truly survive. And we know if you put a human in just a box, that eventually they're going to go crazy. So that's the same thing. If you're sitting at your house all day, eventually you are going to have health degrade very fast. And so the most important thing is just getting out into groups, volunteering. That's a great way to at least get that social connection and do something that you have purpose for. We talk all the time with our clients is, do you have a charitable giving idea? I mean, if you're going to have $2-3 million, maybe it's only $200,000 left over at the end. Is there some type of a legacy? Is there a nonprofit that you want that money to go to instead of a family member that you don't think will spend it correctly? At Tucson, we work, and I'm a trusted charitable advisor that can help you understand your different charitable vehicles that you can utilize that might be different and suitable for you depending on your situation. There's donor advised funds, there's family endowments, sometimes there's just a straight up qualified charitable distribution. Whatever you're trying to accomplish in terms of giving and charity, we can help you get there as well.
And also that's such a good way to give yourself a sense of purpose in times where people do feel aimless.
Those are the conversations I have with people all the time. What are you going to do? Okay? I'm at your age. What are we going to do? This is what I'm doing. I love to coach football. I love to come to work and do stuff. I love to mentor stuff. I love to give back. I want to do things. Yeah, I have my down days that I like to just sit there all day on Sunday and watch football or Saturday and do stuff. That's great. But I have to do other stuff.
Right.
Go play pickleball. Go do something. Okay? And I'm telling you, my grandmother was 94 when she came here for my wedding, and she went home and she came back and said, I'm moving. Okay? And she lived to 101. She never would have made it that long because she lived in Queens underneath the L train, And then my dad, they came out here. He lived 20 years longer because he retired when he was about 58, and he lived to 88, but he never would have made it to that long if he stayed in New York because you know what? He got colder, he would be a couch potato. At least when he came out here, he was doing stuff. He was going out. He was being active. He enjoyed himself.
Well, I think that this is such an important conversation. It's really interesting to see how well you know your clients and how kind of emotionally involved you have to get in somebody's life to help them really figure out how to get to where they want to be in their retirement. So if these aren't conversations you've had, either scan that QR code, call 520-544-4909, or check out their website, greenbergfinancial.com, and you can get the quarterly workshops. And we hope you'll join us on the next Money Matters.